Greetings, everybody. Welcome to the Liberty Call. Today is Wednesday, February 22nd, 2023. So it's 2-2-2023. So, I guess last year it was 2-2-2-2-2. But anyways, hope everyone's having a fantastical day out there. I'm trying to be quick. I know I'm a little bit late in the day. I've got a bunch of meetings and my 4 o'clock has not shown up. So I'm going to go ahead and do my video real quick before my 5. So hope, like I said, hope everybody's having a fantastic day out there. Not the prettiest day in the markets. Things did not end on a good note for the Dow and the S&P. NASDAQ finished in the green, but I see a ton of red on my screen here. I mean, from Asia through the European markets this afternoon or earlier today, and then more of the same here in the domestic markets locally. So if it's your first time watching Liberty Call, please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. I'd greatly appreciate it. I'm sure there's someone out there who's like, what the hell's going on with the economy? What's going on with the markets? Send this video to them. I'm sure they greatly appreciate it. All right, let's go ahead and jump into the numbers and see how things turned out today. The Dow Jones was down 0.26, closed at 33,045. SP 500 was down 0.16, closed at 39.91. NASDAQ up 0.13, closed at 11,507. The VIX fell today 2.54%. It's currently at 22.29. Canada was down 0.29. Brazil down 1.85%. Mexico down 0.11. Our friends in Europe, starting with Germany, they were up 0.01%, so basically flat. UK down 0.59. France down 0.13. Netherlands down 0.14. Spain down 0.86. Italy down 1.12. Switzerland, a little bright spot here, up 0.16, and Portugal down 1.41%. Both Russian exchanges were barely in the green. The MOEX up 0.01, RTSI up 0.05. And the overnights in Asia, Japan was down 1.34, Australia down 0.29. The Chinese markets, the Shanghai was down 0.47, the SESC component down 0.57, China A50 down 1.11, DJ Shanghai down 0.53, Hang Seng down 0.51, and the Taiwan weighted down 0.93%. So, like I said, it was a pretty ugly day for trading day 222. But again, if you've been playing along and watching these videos on a regular basis, you are aware that things are probably going to get worse before they get better, just because just the way it is. I mean, looking at the charts, everything appears, from my point of view, that things are probably going to be sideways or down for at least till summertime, would be my best guess. So, all right, let's go ahead and go through today's market recap. Stock market today, Dow closes lower as Fed minutes keep rate hike worries alive. Bring up my notes. All right. There we go. All right. The Dow Jones Industrial Average closed lower on Wednesday, fluctuating between gains and losses as the Federal Reserve's February meeting minutes added to expectations of further rate hikes to control inflation. The minutes showed that the Fed members continued to anticipate ongoing increases, and a restrictive policy stance may be necessary to ensure that inflation was on a substantially downward trend. The willingness of the Fed members to persist with rate hikes has likely strengthened since the meeting following recent strong economic data. Treasury yields moved off session lows after the minutes release, with the 10-year yield closing near its highs of the day. The energy sector was the biggest drag on the market, driven by falling oil prices, a stronger dollar, and concerns that tighter monetary policy could affect energy demand. The earnings front offered a mixed picture, with TJX companies reporting inline fourth quarter earnings and revenue that topped expectations, but its guidance fell short of Wall Street estimates, sending its shares almost 2% lower. Palo Alto Networks, easier for me to say, reported second quarter results that topped Wall Street estimates on both the top and bottom lines, and Wedbush raised its price target on the stock to $210 from $200. However, Coinbase Global closed over 1% lower, despite reporting a smaller loss than expected, as cost cuts helped ease the blow from falling trading volumes. Intel Corporation cut its quarterly dividend by over 65% to shore up its balance sheet, sending its price down more than 2%. All right, so that's everything in the current market recap. Let's take a quick look at an article here. It's Fed officials back ongoing rate hikes to quell above target inflation, Fed minutes. So let me bring up my notes from that and see what we have to say. Federal Reserve policymakers have called for further monetary policy tightening until there were substantially, that's in quotes, more signs of slowing inflation, with few members backing a faster path to push rates to restrictive levels as tight labor market threatens to underpin inflation, according to the Fed's January 31 through February 1st meeting minutes. Excuse me. All participants continue to anticipate that ongoing increases in the target range for the federal funds rate would be appropriate to achieve the committee's objectives. The upside risk to inflation outlook remained a, quote, key factor shaping the policy outlook, end quote, and a restrictive policy stance likely needs to be maintained, the minutes showed. Data showing a reduction in the pace of inflation was welcomed before the meeting, but members stressed that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was on a sustained downward path. And with some of these reports, like the PPI and the employment reports, just isn't showing any signs that they can take it the other direction. At the conclusion of the previous meeting, the FOMC raised its benchmark rate by 0.25% to a range of 4.5 to 4 3/4. It was the second straight meeting that the pace of rate hikes was slowed as the rate setting committee seeks to assess the impact of prior rate hikes, which included 4 jumbo-sized 75 basis point hikes in 2022 on the economy. However, a few members were against the move to downshift to a 25 basis point rate hike, preferring to maintain a 50 basis point pace to push rates to restrictive policy as quickly as possible. I would agree with that. I personally would have been raising rates by a full percentage point each time. Boom, boom, boom. We get up to 6, 7, 8%, and we squish the inflation back down. But hey, maybe this, eating an elephant one bite at a time is going to solve the problem. I'm just looking back historically, looking back at, the early 80s. Paul Volcker, who was the Fed chair at the time, had to raise rates up into the high teens. And he had to actually do that on multiple occasions because the inflation was just sticky, but it was after a full decade of a lot of inflation. Again, we have a lot of pent-up inflation that's been building up over really since the mortgage crisis, because rates were kept at or near zero for an extended period of time, really until about 2017. And so we've had basically a decade of free credit and cash. And now we're living with the consequences. Plus, then when you tack on the extra $5 trillion in new money into the M2, into the monetary base, I mean, it's a calamity. So, all right. A June rate hike would put the Fed funds rate in a range of 5.25 to 5.5, beyond the 5 to 5.25 projected by the Fed in December. The hawkish repricing of the Fed's rate hikes path has been driven by surprisingly strong economic data, including red-hot January jobs data, further signs of sticky inflation, and a strong retail sales report that suggests more hikes are needed to dent the strength in the economy. In the weeks since the Fed's decision, market participants are now expecting that it will hike at its next 2 meetings in March and May, and are tentatively baking in a June rate increase. A recent wave of hawkish commentary from some Fed members also played a role in supporting rate hike expectations. Expectations for higher peak level interest rates or terminal rate have seen Treasury yields rise sharply, ushering in fresh uncertainty in markets that was wreaked havoc on growth stocks, including tech. Analysts predict that there will be at least another 50 to 75 basis points in hikes before this is over. All right. So that's everything I had there. All right. We're doing good on time. Last up, U.S. home sales post 12th straight monthly drop. House price inflation is slowing. So maybe a little bit of good news there. The U.S. housing market experienced a marginal decline in existing home sales in January, falling 0.7% to a seasonally adjusted annual rate of 4 million units, the lowest level since 2010. This marked the 12th straight monthly decline in sales, the longest such stretch since 1999. Boy, I remember 99. I still had hair back then. Not as much as I did when I was 20, but I still had hair on the top of my head. I didn't shave it off till 2003. Let's see here. However, sales rose in the South since 99, and sales in the Northeast and Midwest, and sales fell in the Northeast and Midwest, probably due to harsh weather. Yeah, it's pretty cold here. It's snowing today. However, sales rose in the South and the West despite the decline. The pace of the drop slowed, which has raised cautious optimism that the housing market slump could be nearing a bottom. Sam Hall, a property economist at Capital Economics, said the marginal decline in existing home sales in January supports the view that housing market activity is reaching a trough, but economists' economic headwinds and stretched affordability mean that sales will recover only gradually this year. The housing market has been the biggest casualty of the Federal Reserve's aggressive monetary policy tightening. Residential investment has contracted for the seven straight quarters, the longest such stretch since 2009. Government data last week showed single-family home building and permits for future home construction declining in January. The 30-year fixed mortgage rate rose to an average of 6.32% last week from 6.12% the prior week, reflecting a spike in U.S. Treasury yields. Despite the decline in home sales, there are some rays of hope. Home builders' confidence rose to a 5-month high in February, though morale remains depressed. The median existing housing price increased 1.3% from a year earlier to $359,000 in January as homeowners whose properties have been on the market for a while lowered asking prices. This was the smallest annual gain since February of 2012. Furthermore, properties typically remained on the market for 33 days last month, up from 26 days in December. Lawrence Yoon, chief economist at the National Association of Realtors, said that buyers are beginning to have better negotiating power, and homes sitting on the market for more than 60 days can be purchased for around 10% less than the original list price. At January sales pace, it would take 2.9 months to exhaust the current inventory of existing homes, up 1.6 months from a year ago. Up from 1.6 months a year ago. 4 to 7 month supply is viewed as a healthy balance between supply and demand. 54% of homes sold in January were on the market less than a month, and first-time buyers accounted for 31% of sales, up from 27% a year ago. All cash sales made up 29% of transactions compared to 27% a year ago, although the housing market is still searching for a floor. Business activity rebounded in February, reaching its highest level in 8 months, according to the survey. All right, well, that's everything I had to talk about today. We had some interesting news as far as what the Fed's thinking, as far as home sales, and hopefully, like I said, things are going to get worse in some aspects, but other things are getting better. I think the employment situation will probably be a laggard just because think about it this way. If you own a business, say we got Ray's Tacos and I got 10 employees and, we've gone, say 2 months with slower sales. Am I going to start firing people? If I have a good savings, probably not. We go 6 months with an extended drought in sales. At that point, we're starting to look at, hey, we need to start slashing overhead and, let's say get rid of, 20% of our staff. So it's that sort of situation. So it's usually you have to be lean and hungry for a while before you start cannibalizing your workforce. And especially after the last few years where it's been hard enough to get talent in the door, a lot of people just aren't real quick to start laying people off. But anyways, so like I said, my personal view is that I think, the market will probably start to turn around at about 18 months from peak to trough, which puts us somewhere in the summertime. And then, probably at that point, the labor numbers will probably start to look pretty bad. And then it'll probably take another 6 months to a year for, businesses that are back on their feet to, rehire. It's just in the cycle. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a wonderful evening, and I'll talk to you next time. Adios.